Our first question for today's open discussion presentation comes from Paul via email, and it's related to managing an iron condor and evaluating rollout opportunities in our portfolio tools. Okay, so Paul starts off his comments, with the fact that he's found many YouTube videos with people claiming to be experts on trading the iron condor. And we'll explain what an iron condor is if those of you are new in just a moment. Now, once they're into the iron condor, they're the YouTube experts. Trade management differs greatly, such as always close your position when you have achieved a 25% profit, a 33% profit, a 50% profit, or 75% of profit, depending on which video Paul was listening to. Okay, so you've got experts out there making these claims. Now, let me jump in here before we get to the main crux of Paul's questions to me. And let me just state a few things first, honestly. A few things on that comment. I do not consider myself an expert on iron condors, and I would never say that. Ernie and Mike Phillips, a gentleman that used to work with us, have a book written on the iron condor strategy. Mr. Mike Phillips was really big into iron condors and was fairly successful with them most of the time. More successful than most investors I know with them for a fair amount of time. I personally stopped trading and stopped looking at iron condors about 3 years ago, maybe even 2.5. Why? Well, we'll take a look at a chart of QQQ and SPY later. The reason why is I got sick of closing the call side, right? Because you look at a stock chart over the last 2 years and the broad-based indexes were just moving up and up. Sure, they were gradual, but I was finding myself closing the bull call or the bear call credit spread side more often than not and taking losses on things that would have just been a gain with a bull put. So for the last 2 years, I've been doing just the vertical spreads, either a bull put credit or a bear call credit on something I found that's bearish, rather than doing both sides and creating a neutral position in a market that was continuing to rise. Okay. Now, Paul, in relation to your comment about, this guy over here is saying close your position at 25% gain. So if you collected $1 net credit, you should close it if your liquidation value is 75 cents, and you'd keep 25 cents of profit. And this expert over here, she's saying that you should close at 33. Then you've got another expert who's saying you should close it at a 50% profit, and another one saying you should close it at 75. I can't really comment on that other than to say, first, establish your own personal targets for a position and for the strategy. Have your trading plan ready. Second, go back and look at your track record and your performance of maybe the past 8 or 9 iron condors you've opened if you've been trading them for a while. And see how your track record would have been if you would have closed those positions when you had a 25% profit. Whether they were winners or losers, the minute you closed the 25%, look at all your positions. They've never reached 25% or so and they stayed open and you took a different loss, whatever. But see how your portfolio would have performed if at any time during that situation, any time during the trade was open, if you would have closed it at 25% profit when it was hit, if you closed it at 33, if you closed it at 50, or if you closed it at 75. And then compare that spreadsheet. Compare that together to say, okay, well, over 6 months period, if I didn't follow those rules, here was my return. If I followed the 25% rule, here was my return. If I followed the 33% rule here, and so forth, okay? Map it out. See which one best suits and was most successful. The problem with putting stops, even for losses, but the problems with putting stops on vertical spreads and iron condors as a whole is you might find yourself closing out positions too soon and for too little of a profit. And by the way, just on note on that real quick, 25% seems really low to me, especially if you're trying to pull weekly vertical spreads or weekly iron condors with a good probability above or between and you're going a far range out of the money. Because if I'm only taking 15 cents in net credit total on a 1-point spread, which is still around a 12-15% return or higher, actually it's around 20% return, let's say, and making 15 cents on an 85 cent risk, for example, with a 1-point spread. Well, 25% of that is if I could liquidate it for 12 cents or so, a little bit less than that. If I could close it for 11 cents or so and make 5 cents on the position, be about a 25% return. Well, depending on how many contracts you're doing, that doesn't sound like a good play to me. You want the most you can get of that initial 15-cent net credit. Okay? All right, so some ranges to me might not make sense, but look back on yourself and see how your portfolio would have performed if you would have closed them with a 25% gain, or if you would have closed them all at 33%. And if they never hit it, well, okay, they never hit it, so forth. Now, aside from that, premium generation strategies in relation to closing these positions at 25, 33, 50, or 75% gain, in general, Uri and I follow the 80% rule. If you've made 80% of what you expected to make on the position, it's called the 80-20 rule, then go ahead and liquidate the position. Okay, that's our rule of thumb on it. But again, I haven't traded iron condors on purpose in about 3 years. Okay, what do I mean by on purpose? I've legged into an iron condor when I had a bull put open, the stock seemed to stagnate, and I still had about 18 days to expiration. I entered a bear call. Technically, I have an iron condor now, but I legged into it. I didn't open it from the beginning. All right, but let's get to where I can come in to help Paul's questions, really. Paul says, now, when he's tracking his position in the Power Options portfolio tools, the tools show 3 suggested ways to manage an iron condor based on what his stock has done. And Paul's comment is, I don't understand one of the adjustments. He said, I don't understand why one would ever close one side of the spread. While the probability of losing money would be remote, the potential gains are tiny relative to the potential loss. Okay, so what is he talking about? We're going to take a look at all of this. Oh, sorry. It's being jumpy. There we go. The iron condor Paul's looking at. And I don't know what day he did this, but here's his iron condor as it stands right now. He entered into a bull put spread. You know, the iron condor is a combination of a bull put spread and a bear call spread. So here is our bull put spread side, where he sold the 134 put for 24 cents and bought the 132 for 18 cents. So we have a 0.6 cent net credit on our bull put. At the same time, we entered a bear call spread. Okay, so here on the bear call spread, we sold a 145.50 and bought a 147.50. I think that's a misprint. I'm pretty sure it was a 147.50. It was a 2-point spread as well. And this gave a credit of 56 cents on the bear call side. So there's an iron condor. It's a neutral position where we want the stock to remain between these 2 strikes, combination of a bull put and our bear call to create the condor. Now, so we've got a total net credit of 62 cents taken in, but right now, QQQ is at 143.47, within 1.4% of the short call strike price. Okay, being within 1% or so of the short call or the short put strike price is a trigger point for us where we would look to manage the position. Okay, so here's the profit and loss chart for the iron condor. As long as the stock stays between both strike prices, all 4 options will expire worthless, and Paul will keep the entire net credit. Remember, we had a net credit of 62 cents, was selling the 134 here, so the break even to the low side is 133.38. And then to the upside, it'd be 146.12. Okay, because we sold a 145.50 plus 62 cents is 146.12. These are the upper and lower break evens. As long as it stays between there, you'll have a profit. But of course, if it's trading right at these prices, it's a wash. Trade is at break even. Okay, so now the stock is moving up and it's close to our short call strike price. And remember, these are for the 18th of August expiration, so we still have about 2 weeks to go. And the security, in general, I open an iron condor when the stock is right in the middle of the strike prices I'm selling. I look for equidistance personally. Okay, so now that it's moved up, well, the stock's kind of moving against my original expectation of a neutral strategy. And I have time remaining. Okay, so one of the positions that we're going to take a look at in a moment that came up in Power Options was to close this leg of the spread. And Paul asked, why would you ever do that? Why would you pay money to close this spread when it's still between the strike prices because you've lowered the potential return if the stock does stay up? Well, honestly, it's to remove potential loss. If this continues, if QQQ continues on the trend it's been on, pretty soon I might find myself in this area. Okay, I want to avoid that if possible. All right? Okay. So going back to square one, I don't ever understand why one would close one side of the spread. Why would power options suggest closing the bear call side? Because the stock is moving up to the short strike price. So the probability of losing money will be remote. The potential gains are now tiny relative to the loss. That's right. Well, it's to avoid potential larger losses. This assumes that you originally started the position and that bear call, your sold call, was maybe 3 or 4% out of the money to start with. So now it's gone against your expectation of staying within the bounds. It's moving in one direction, getting close to your short option strike price, which is the pivot for this strategy. Okay, so why would I close that side? To avoid potential loss if it looks like QQQ is on a bullish run and will continue that bullish run, because if I don't do anything, I might have a larger loss, will likely have a larger loss on the bear call side. So why close early? To avoid the loss. Okay, now another adjustment that was shown was to close the current iron condor and move it further out in time. And Paul said, as for rolling the entire iron condor, others speak in terms of delta or in terms of probabilities. Okay, that's fine. We typically don't speak in terms of deltas related to the vertical spreads in the iron condors. Not our approach. We don't really think it's necessary. We do show that on power options, but it's not what we look for. Okay. And he also mentioned that the wings don't have equal distances from the price of the underlying at the start of the trade. And you say, find it difficult to understand suggested rolls without seeing deltas or probabilities. Okay, well again, I don't like to look at iron condors in terms of delta. I refer to it in terms of probabilities. And if I was opening an iron condor, I don't do a bullish or bearish basis on a condor. If I was to open a condor right now, I probably would do a bullish basis, just based on what the market trend has been. Meaning what? Meaning my put side, my bull put might only be 1.5 to 2% out of the money, but my bear call side might be 3 or 4% out of the money, a bullish bias. I can tell just by the net credits that you established, you actually, this condor, let me go back. You can just tell by the net credits themselves. There we go. This condor, when you opened it, was biased towards the call side. What do I mean by that? Obviously, this call side was less out of the money because the premium of the short call is 4 times that of your short put. So the stock might have been trading at 141 or 142 when you opened this trade, which means you had a bearish bias. Your calls were closer, so you're probably expecting QQQ to fall and have a bearish bias, but never reach 134. So you could take a chance going less out of the money with your short call to get this higher 62-cent net premium. Because if you were equidistant, and maybe you were at the 149 or the 150 call and got another 6 cents, sure, you'd only have a 12-cent net credit. So here, because the stock was probably closer to the call side at the time, you actually had a bearish sentiment. Okay, and didn't look like we did a lot of bears this week. I mean, there was some hesitation, but not a lot. I'm waiting for a correction, by the way. Can I promise you it's going to happen by the 18th of August? No, can't do that. But what I'm saying is that is giving, you did set up with a bias. I don't do that. I go equidistant, personally, okay? But in any case, let's talk about Paul's concern with the rollout shown on power options and why they would be done, in our view. And we'll break down the risk and rewards of the adjustments and talk about what the position analysis actually means as well. Okay, all right, so let me pause this. Let's navigate over to the power options suite of tools. Yeah, I think I'm going to go this route. Give me 1 second, folks. Okay. No, I want to keep it over here for the time being. I'm sorry. Playing with my monitors. I apologize. All right. Okay, so let me go ahead and show this. Not that. There we go. Let's take a look at the power options screen. There it is. Okay, it came up there. And I'm going to go to the portfolio tools and my portfolios. Now, I entered in the iron condors Paul mentioned. Here it is down at the bottom. So the power options portfolio tools will arrange your positions by strategy. My iron condor is down here at the bottom. Here is our 62-cent net credit. We're just looking at one contract here. The current price and liquidation value is 39 cents. So right now, we do have a small profit of 37% on the position, with 14 days remaining to expiration on August 18th. Okay, so if I liquidate it, it will cost me 39 cents. We're still going to have a 23% profit, which is 37% of the $62 we expected to make initially. And our expiration value, well, this is not a projection. It's simply saying if the stock stays where it is between now and expiration, well, then in that case, we'll go ahead and close the position out as well. Okay? All right. Now, before I show the rollout opportunities in the discussion, James made a comment here related to what you were talking about as well. Paul and James says, I've heard recommendation is to roll the spread out if the short delta is greater than 0.22, okay, or meaning the delta is higher than 22. So yeah, if you opened it with a delta of 12, okay, the delta of the short strike is more than 2.2, you'd want to roll the position, which would equate to about a 78% probability below. Okay, so you're saying that if you maybe opened it at 85% or a delta of 15, but once it hits 22 to close it. Okay, that's a way. Okay, depending on your threshold, depending what your original search was. Most of my positions are probably going to be in the delta range of around 0.80 of a short option or a short put as well. So I can go ahead and say that for me personally, that 22 delta wouldn't work because that's about where I'm opening it for my bull calls and, my bull puts and my bear calls, okay? And in light of that, when you're tracking any position in power options, okay, and you're opening with a delta of below 11, okay, so if doubles goes to 0.22, it's great to have a trigger. I have no problem with that, okay? And that can probably work long term. But remember, just make sure you're not closing your positions too early, all right? All right, so here's the Greeks view here. Remember, so you can see all of your deltas together on your different positions. Delta of the short calls at 0.32. So what does that mean? James would be closing his position right now. He would have closed that when this delta got to 0.22. But again, based on the premium we saw, where this was 88 cents and the short put was only 24 cents, we were much closer to at the money when we opened this. So we are probably well beyond that already for this Condor, okay? All right. Now, anytime I'm tracking any position in the portfolio, I can link to the position analysis screen. So using the more information buttons, we can go to position actions and then position analysis. And this gives us a breakdown of our current position. Once again now, we see the stocks at 143.65, changed a little bit from when I started the slides. It's getting close to within that 1% of my short call strike price where I might look to manage the position. Personally, what we have in power options as one of our triggers, okay? James just gave us another trigger, but that's based on opening an iron condor where the short options have a delta of 11 or 0.11 to start, and he's going to look to close or adjust if it reaches 0.22. Short option delta. We're well beyond that. We're at 0.32 now. Okay. Now, as you scroll down, you can see what we saw before. What is my liquidation value on the position? Okay, so we could make about $20 to $23 right now at midpoint, 35% of what we expected to make if we liquidated. And then we see the rollout opportunities. Okay, it shows us that QQQ has moved within 1% of our short call. One thing I will say Paul brought to my attention, based on my math, this is still only about 1.3, 1.4% out of the money. It's not within 1% yet. I'm going to have to look at the programmers on that and see why that's being triggered, because I didn't think it would trigger yet. But it's not a bad play to trigger. It's okay. And it says we may want to consider closing both legs of the call spread. Why? Because that's the side that's being threatened. The stock continues to go up, I can start realizing higher losses. Why is the system showing this? Because it assumes that you want it to stay within a reasonable range out of the money on both legs. And it's assuming that now that the stock is reaching a trigger point for the upper strike of the short call or the lower strike of the short put, now that it's hit that trigger point, you might want to limit the losses and close the position because you want it to remain further out of the money when you spread. Okay, so it would cost you 40 cents only to close the call side. So you still have a 22-cent net credit, and now you're at a 99.7% probability of staying above the short put. Okay, so we close the one side of the bear call. What does that do? It leaves us with a bull put with a smaller potential profit now, okay, on the position of only 6 cents. But remember, we're keeping, this is going to be closed for 40 cents, so we're keeping 40 cents at midpoint, I believe. And, no, I'm sorry, we're keeping 20, so the profit would be 26 cents. So Paul's argument was, you have such a low possibility of profit, although the probability is high at 99.7%. Yes, again, because the system's assuming that you didn't want it to go above the short call, you'd want to manage it before it went above the short call strike price. Okay, because it's assuming that this position has been moving against you, that you started it here when the stock was maybe around 139 at the midpoint or 140 between the two strike prices. Really, yeah, about 139. So now the stock's moved up to 143. It's gone up about 4 points from where you started, and it's threatening the short call. Okay, so that's why this is being shown. Why would you do it? Because you want to avoid further losses if your sentiment is that QQQ will continue to go up in price and may breach not only the short call, but the long call as well. Here's another adjustment. Close only the short leg. This is more expensive. It cuts into the net credit more. We'd only have a net credit of 13 cents, but we could buy to close the short call for 49 cents. Why would I do that? Well, again, if I'm in a sentiment where I think QQQ may continue to move up, if I stay in the iron condor, that's in red, and it does continue to move up, I'll be at a loss area. But if I buy to close the short and the stock continues up, the ETF continues up, let's say it goes to 150, by closing the short, I can actually have infinite upside profit. The only time you would see this position if you're still more than 7 to 10, I think it's about 10 days, maybe 8 days to expiration. If you're within 2 days to expiration, this adjustment makes no sense. It's highly improbable that QQQ in the next 2 days would go from 143 to 149. Could happen, unlikely. But 14 days? Based on the movements that it's been on, you know, it's going to take away this credit. You're going to have a small credit now of only $26. And it would be a loss in the middle. That's unfortunate. Sometimes you can do this where you still have a small gain, as you mentioned, in the middle, but still have infinite upside. But that's if your sentiment is completely changed. You move from neutral to bullish because of the market trend. Maybe things are moving beyond your expectations. And you say, this wasn't a good idea for neutral trade. I think it's going to continue to go up. Well, one potential idea is just close the short, leave the long open for the next 14 days, let it go. Now you've got some infinite upside. Hey, Paul didn't ask a question about that adjustment, but that's another one. Now, rolling the whole condor. And I think this is where Paul's dilemma was coming from, where he made that reference that the wings aren't equidistant, and I don't like analyzing the position without looking at probability and delta. Okay, well, thank you for the comment. I appreciate the feedback. Maybe delta is something I can have the programmers put into you on the analysis page. But look at the spreads that it created. Okay, it's looking to buy to close your whole condor. This is a common adjustment, rolling the whole credit spread or rolling the whole condor as well. But we could liquidate the entire condor for 42 cents. It's not at midpoint, okay, so that's just a rough natural bid and ask. So right now, you'd still keep 20 cents of net credit. You could close this for a profit right now, okay? But then the rolls you see with the stock, remember, being at 143.65, the spreads you see are going to the 136, 131, and the 151, 156 5-point spread out to September, now 45 days away, which means essentially this is $7 out of the money for the short put, $7.65, okay, and we're about $7.15 out of the money. Why do I even bring that up? Well, because when we personally, again, as I mentioned, you can search for them on power options. You can establish a bullish or bearish bias on your iron condors. We don't when we evaluate the rollout opportunities. Personally, when Ernie and I open an iron condor, we are equidistant. We don't do a bullish or bearish bias. So that's why we're right around the midpoint of 144. Essentially, okay, 7 points up and 8 points down, as it were, but that's close range. So you're looking at a 151, 156 bear call, to September 15th with a 136, 131. Okay, and then the strikes change. Higher or lower strike differences, okay, the 155, 154. We show the probability between. What is the new probability between for your new iron condor position 45 days out to September expiration? I won't show the probability of the individual options, but I could do that real quick. So I could go directly to the option chain here. Remember, we were talking about selling the September 15th, rolling out, excuse me. I don't have it selected, but I could choose it in the column there on the chain to have the probability shown on my spread chain here, my call and put chain. So let's just get the probabilities there. There we go. Probability below for my call. Probability above for my put. Sorry about that. All right. Okay, so now in September, the 151 is 94.2% for the call, and the 136 is at 82.4. Okay, so yeah, you could customize that to see it with one click. I'll see what I can do with the programs. But we focus on the probability between because it's a whole new condor, not just the probability of the short call when we roll or the probability of the short put. We look at the new probability between. And if my goal, my trading plan, is to be in the range of an 80 or 85 probability between, I'm probably not taking any of these potential new condors. Okay? All right, but let's go back to square one. Let's talk about what we're looking at here. These are recommendations based on what Mike Phillips, who wrote the Iron Condor book with Ernie, did in his personal account, what Ernie would do in his personal account, feedback we've had with customers on how they manage their Iron Condors. A 1% trigger is useful. The delta trigger that Jim mentioned is useful. If I had entered a position, for example, an Iron Condor, where I didn't want the percent Bollinger Band range to be greater than 40%, or the spread width, the Bollinger Band width to be more than 40%, and I didn't want the MACDs to be more than 2 to 3 days growth apart, well, I might set those in my search, but then use those as triggers also. But what we're showing you here are ideas to manage the position. And they're ideas based on the assumption that you would have started a trade in the middle, equidistant. So now that it's really close, within 1.5% I think would be the trigger here, but now it's within 1.5% of either strike, what are some adjustments you could do if you decided to? You could decide to close the one leg, the spread that's being threatened. You could just close the short leg if your sentiment has changed and you're bullish and you think it's going to continue to move up. Okay, leave the long open for an increase in value to potentially counter any losses from closing the short. Okay, or roll to a whole new Iron Condor. We're not saying these are things you should do or you have to do. These are things you could do. If you open this with a bearish bias to begin with, that you wanted to maximize your money on the bear call by only going 1 or 2 strikes out of the money, thinking the stock is going to pull back here and be right in the middle, this might not be a good trigger point for you. This doesn't match your way of trading Iron Condors. I appreciate that. Okay? There are improvements that can be made to the portfolio based on your feedback, looking at delta of the short options maybe, or the probability of just the 2 short options themselves when evaluating a rollout. I will talk to the programmers about that. But the key thing I want to get across to you is that here in the portfolio, when you're tracking any position, you can link to the position analysis screen and see potential rollout opportunities. These are suggestions. These are ideas, but not the de facto you should close the short call. You should close the call legs. You could, but it still comes down to your choice based on your trading plan, your underlying sentiment for QQQ. We're just doing the heavy lifting for you and showing you the new numbers. Right? If I did close this, I'm left with a bull put that has a lower gain than possible, but I avoid taking the loss if QQQ continues up and goes above both call strike prices in the next 14 days. Adjustment 2, if you've now turned bullish, hey, you want to think about buying that long call back and leave the other 3 legs open? We saw that profit and loss chart. What could happen? if QQQ continues up in the next 14 days. You want a wider breadth. Give you a little bit more cushion to the upside, a little more cushion maybe to the downside. Actually, this is less cushion to the downside, but more cushion to the upside. Here are some ideas for rolling the whole Condor out, still keeping above a 78% probability between, still with a reasonable net credit return. Okay. Honestly, if I'm in this position right now, naturally I can't do anything because we've already closed for the market today, but I'm going to wait till Monday. If this pulls back and it drops down maybe to 141 or maybe 142.50 is more likely, I'm looking a little bit better, might not be worried about adjusting it. If I see this go up to 144.50, I'm starting to get concerned. If it goes, this index ETF goes up 90 cents Monday, I'm getting really concerned about this. Because if it just keeps going, why bother? Why take that chance? Yeah, I'm still far from my break even of 146.12, but I'm putting pressure on this upside. Okay, you've got a bearish sentiment on this Condor right now. You need it to pull back to be a little bit more safe. You need it to stop the move that it's on. Okay, all right. And Jim made another mention, if the spread can be closed for 1/3, there's that 33%. You guys probably watch the same YouTube videos. But James says if the spread can be closed for 1/3 of its initial credit, which we're close to now, right? We could close it for 49 cents. I think the whole liquidation was. Where's my liquidation down here? Here we go. Liquidation value is 42 cents. We originally received 62 cents, so we still have a 20-cent net credit. About a third, still keeping a third of that. And he says you could go to at the money. It could be rolled closer to at the money. It could be. Okay? James, you're right. There are a number of new iron condors I could choose, probably even in August expirations as well, that are closer to at the money. But remember, we only want to show ideas that an investor would consider as a whole new position. And most of the time we're looking for probabilities above 75% probability between when we open an iron condor. So that's really why the only condors you're seeing are the ones that have that combined 78% probability between. You absolutely could do other positions. As I mentioned, I'm not saying these are all the positions available. I'm not saying these are the de facto positions, the only ones you should consider. I'm saying we're doing the heavy lifting. We're showing you the numbers and, of course, the new profit and loss chart and that simulate trade feature to give you ideas. Okay? But it all depends on your original trading plan. For example, another example is this. I have a gentleman who just started with power options. I had a coaching session on Monday with him. He does in-the-money covered calls with part of his portfolio. Not only covered calls, but he does in-the-money covered calls. So he's testing out the tools, trying them out. He's got his positions entered in the portfolio, the 8 or 10 covered calls he has for this week, doing weekly options. And all of his positions are in the money. And he goes to the position analysis, and he sees rollout opportunities to 7 days further out in time, 14 days, second week and third week out in time. And he says, why would I roll? I want to be assigned. Okay, we're just showing you ideas that if you wanted to roll up a covered call, this is what it would look like. These are the numbers. This is your new profit and loss chart. If your trading plan is to get assigned, just get out of the positions with your 0.8 or 0.9% return on a 5-day trade and not worry about rolling, then don't even look at the position analysis unless the stock falls below your strike price and you need to manage it. Okay, so it's also based on what your trading plan. And I agree with you. If you're setting up sort of biased condors for one market direction or the other, these rollouts might not make the most sense to you because your goal was to enter this position here for a bearish bias that just hasn't kicked in. Okay, well, if that's your sentiment, leave it alone. These rollout opportunities are things that some other investors might do, might not match your needs, but you might not want to consider rolling it right now if this is your structure. If you're in a bearish bias for the next 14 days because you feel QQQ is going to come back to 138 or 139 in the middle of these two and you're trying to maximize profit with an at-the-money call or at-the-money put. All right, so let's go back here. Sam says, this was from the very beginning. Sam says, hi, good afternoon to all in the room. And Sam says, how will it look if I had a debit spread on AAOI before earnings at 3:45 p.m.? Stock was at 99 price, and I placed a debit at 95.90. Would cost $6. Stock closed at 64. Had to close before 4 p.m. Okay, that's not a good trade. So what I think Sam is talking about here is that AAOI, we all saw, had that big movement today. All right, there's a lot of other big movements we saw today, but AAOI was one of them. And he's saying right before 3:45, I'm sorry, was it yesterday? Before earnings at 3:45 p.m. Okay, so the earnings were last night, okay? And, you know, you said the 95.90. Okay, so, but you're talking about, I'm sorry. I'm assuming you meant a bear debit spread, not a bull debit spread. All right, so let's go back to yesterday. Oops, sorry about that. Let's go back to yesterday. Go back to the chain here. Go back. Now, this is going to be at the close. And let's say you're doing a bear put debit, 95.90, I'm assuming. Chancy. So looking here, the 90 was 230 to 320. Midpoint would have been 275 on the put, Sam. Okay. The 95, 430 to 440. That's easy enough. It's 435. Okay, that's actually, oh, it was in the wrong one, was I? No, it was in the 90. 230 to 320. Yeah, that's good. And the 95 at 430 to 440, bid and ask. That was at the close of yesterday. Okay. So let's enter a bear put debit spread, which I'm assuming you meant. I don't know if you would have done a bull call at those prices. And we'll take today's expiration. And what do I do in a bear put debit? All right, well, I sell. Geez, can't even find them. Sorry. I'm sorry. We're going to do a 95.90 bear put debit. And what does that mean? It means I'm going to sell the 90, the lower strike put, for 275. Bought this at 435. Now these were the closing prices. You said a debit of 6, okay? And hold on, there we go. Okay. James closed AAOI before profit, before earnings. Okay, you said buy 95. Yep. Sell a 90. Okay, there you go. All right. Okay, so this was the bear put debit spread. I could have opened with a max profit of 340 for a debit of 160. You said $6. See, that I never would have done. Even if you're playing Volatility Crush or other things, I can't justify entering a debit where the maximum return I get back, or the maximum I can get back, is the difference in the strike prices of 5 points. In the worst case scenario, when there's no time value at all in the options. Okay, I'm going to battle bid-ask spreads all day. But here, because the stock fell and it's below both, if you paid $6 to get in, you'd be guaranteed a 1-point loss. Okay? You'd have had to leg in and out at different times. You'd have to time this differently, where you bought to close one at one time and then waited, and then sold to close one later on as AAOI continued to fall in price. So yeah, my one rule of thumb is, even if you're, I don't like to play that game. What game am I talking about? I'm talking about knowing that this had earnings coming up, and we saw about a 30-point drop in the stock today, from about, you know, where it was to about 64.6 or 20 points, whatever it was. A movement, I should say. But in any case, on a debit spread, I get back the difference in strike price. I need to pay a debit that's less than, oh, sorry, my debit needs to be less than the difference in the strike prices, okay? So in that case, I want to pay only $4.10, $4.50, $4.90 even. But if I pay $6 and this collapses and I only get $5 back, I've guaranteed a loss of $1 per contract. Okay, so I wouldn't even looked at that. Could it have been profitable? Sure, if I didn't watch what AAOI did all day, but if it just dropped a little bit beforehand, before it did the full gap, let's say it dropped, or it moved, I'm sorry, let's see, how far, what was the actual numbers it moved? It dropped 33.39, okay? So if in the first hour it was down 20 points, well, if I bought to close the 90 then, and then waited for it to fall another 13 points, then sold to close the put for a higher value, I would have had a profit. But I never try to look at positions where my debit is greater than the strike price, greater than the difference in strike prices at natural bid and natural ask. Midpoint, you should get close, but man, That's a tough gambit. But at the closing prices of yesterday, we did see that this would have been a profit of 212.15. Okay. Sam says he had no position. Let's see what's. Let me move again and go back up here again. Okay. He didn't take any trade. Okay. Okay, Sam offered a thought here earlier on. He says, I think the best is wait for support to open a bull put and buy a call and open a bear call at the resistance with a put for a downturn. So Sam is similar to me. He's more active than I am, but he's similar in the sense that he doesn't do an iron condor off the bat. When you hit a support line, you think it's going to bounce off of it, and that's what Ernie does too. It might look to open a bull put credit spread. And then as the stock continues to move up in price, when it hits the resistance level, then consider maybe entering a bear call. He does it a little bit differently. He does the bull put and buys a call at a cheap price, and as the thing moves up, he's getting more value on the long call, but then he'll sell a call, but he can also sell the long call for a profit too. It's more of a timing game, and I don't want to say game because Sam does a lot of those trades and is usually successful with them as well. Okay, and let's see here. Sam's also commenting that he had also gains on WTW is a huge gain today. The stock dropped to 34. Might not have been a good trade as well. And you didn't have a position on GoPro. I did. It was fun. I did one of my successful strangles today. I had 5 out of 6 successful long strangles today that were closed. And one of them was on GoPro. And let's see, what did I do here? The other day, I got out early though, my fault. Fear of losing it. It was done the day before, I'm sorry. Let's go back. There it is. There it is. $8. I got in on August 2nd, which was Tuesday. Yeah, Tuesday or Wednesday? Wednesday, I'm sorry. This was 38. No, I'm sorry. Reverse that. Strike that, reverse that. This I got in at 38 cents. This they gave me a little bit worse midpoint. I got in at 40, so it was a 78-cent debit on GoPro there for the 8 strikes. And then, of course, the stock popped today. It went as high as 985. Personally, when I saw it at 950, I got out of the 8 strikes for the $1.50, 200% gain. Or I'm sorry, not 200% gain, but yeah, I closed it at $1.58. It had a 78 cents in there, so a little bit over 100%. Yeah, I could have done a little bit better had I held on, but that was a decent one. That was a good return for me. It was on GoPro, and just completely forgot the other one I had today. It's not on this. It's not on this account. It's on my other account. Shake Shack was the one that lost. I was a break even, essentially. It only moved about 3% after earnings, so I paid $1.50 or $1.60 total into the position, and I got back $1.48 on the put because the stock fell slightly. So yeah, that was the some of the ones there that had the good movements. I'm mad at myself, ladies and gentlemen. I'll be honest with you. Is it going to show up today still? Yep, there it is. There's WTW that you were talking about, the Weight Watchers jump, and there's AAOI, of course, NGVC. And YELP is an example of humility and not knowing or thinking you know what's going on in the world, but you don't have the knowledge. YELP was one of the ones that came up on the long straddle search that I was using. So did Yum Brands, which would have been a loss, actually. But YELP was on there, and I didn't trade it because my thought was, seeing how everyone today is using all the different, I know it's an app, I know it's a popular app, obviously, but, as many things are out there for Siri and Alexa for asking questions, what are the best restaurants in the area? I didn't think Yelp was as big anymore. I didn't think it was doing as much business. I haven't heard any advertisements for Yelp except for those new commercials with the on TV with the guy with the beard that talks about your dinner's not so good. Well, here it is. And yeah, I didn't expect this. It was one I could have gotten into. Let's take a look at what Yelp would have been on August 2nd. Again, we'll go back to the chain. I'm upset with myself too because it wasn't really that expensive, to tell you the truth. The spread the straddle was not that expensive for YELP when I was looking at it on August 2nd and August 3rd. Yeah, it actually was pretty expensive. My apologies there. So 32.25, you know, about $1.90 and 2.20 to get into the 32.50. So $1.90 and 2.20. This must not be the one I was thinking of that was successful, that was small. I know what it was. Okay, I'm sorry. My apologies. So we're talking about a debit of 410 at the 32.50 strikes. And 32.50's got to open that chain up here. So 410 to best maybe about 740, 750. Okay, so make $340 profit off of a $410 investment. Okay, so that would have been a pretty good one, obviously. The movement, you can't deny that. It's going to be well over 100%. The other one, believe it or not, was Hecla Mining at 550. I think I paid a total debit of 35 cents for the 550 strikes, and it dropped down to 485. So it went up to about 70 cents to close the 550 put, which I was more than happy with, a 35-cent investment. It might have been lower than that. No, it was 35 cents exactly, 20 cents on the 550 put and 14 cents on the 550 call for Hecla Mining the other day. All right. Okay, so yeah, it was surprise earnings there. Let's see. All right, so Bob, I don't have the knowledge here to help you with your question. I apologize. You said that Dr. Singh does double iron condors. He uses power options. He mentions power options. Ernie has his book. I haven't read it yet. It's supposed to pass down to me, but you know how things go in the office. It's guaranteed to make money. Can you shed light on it? I can't. I'm not really positive if he's layering iron condors. What do I mean by layering an iron condor? Meaning that let's go back to QQQ, my apologies, and let's enter, Bob, close. Let's just enter an equidistant spread that I might do for August 18th. Okay, and I'm not going to look at probabilities or delta. We're just going to run an example. We know the stock's around 143.50, so I'm going to go down to 140, 138, 2-point spread that's about 4 points out of the money. And we'll do the same on the call side. I use the 148 and the 150. Yeah, maybe no. Okay. Yeah, we'll stick with that. Not great, but let's stick with that. Okay, so sell these two. Wow. Ta-da. There's your iron condor. Okay, almost equidistant between the strikes. What do I mean by a layered condor? It's possible that he's doing another condor that's closer, okay, that's not as far apart and not the same strikes. Did I select August 11th? Oh, I did 18th, okay. So now at the same time, maybe he's doing a 142, 141. I'm guessing here, by the way, I have no idea. My apologies. So let's say now that we sell the 141, sell the 142, excuse me, and sell the 145 call, which is not it. It's just, yeah, that's not going to work, okay? You've got double spreads in there. Is he adding a debit condor on top of an iron condor? I'm not sure. Is he doing a double diagonal? Possibility, okay, but there's still ways to lose money. He's been using power options for years. He has our approval to use the site for it, but I cannot shed light on it. And I'm not saying that because I'm not trying to say that, oh, you've got to go buy his book and buy his information there so that he can see it before on that position. I'm just saying that I honestly don't know what he means. I don't know if he's doing a double diagonal, which is not really an iron condor. A double diagonal is if we took the Qs, for example, and go to August 18th again for the shorts, but let's say I sell a 145 call. I'm going to go really close and sold a 142 put, short straddle, or strangle in this case, okay? And at the same time, bought a November 150 call, deeper out of money, 150 and 134 put. Okay? Still ways to lose. Now you could structure this differently using put the calls at lower strike prices. The call and the put at lower strike prices for September. What do I mean by that? Or November. What do I mean by that? When we sold the outer wings in the near term, what if I bought these two? Okay. That's still not looking right. Okay. So I just can't comment on it because I'm not sure exactly the structure he's doing and what he calls a double condor. I don't know what a double condor really is. I don't know if it's layered or staggered. I don't know if he's opening a bull put credit and then opens another condor with a bull call debit that's at a slightly higher strike price and then does the bear call side with a bear put debit. He might be doing a iron condor with a debit condor. I'm not really sure what his structure is. The term double condor can mean multiple things. I don't know what his definition is as far as it goes to that. All right. Oh, Nancy asks, who do you use for your broker? To be honest with you, I've had Options Express since I started with Power Options back in 2001, Nancy. I've had an Options Express account. I have a retirement account at Fidelity where I do most of my collar spreads, my radioactive trades, and other positions. To be honest with you, I was going to transfer my Options Express account to Trade Monster before they got bought out by Options House. And once they merged, I don't want to know if it's really a buyout, but once they merged with Options House, I stopped the thought on that. Why? Well, simply because it's just that I didn't want to have my money when there's a changeover and I'm going to see tools that I wanted to use be changed into tools I haven't really researched and wasn't planning on using. So I just stayed with Options Express. I haven't looked back at Options House since then. I've seen a lot of Thinkorswim's tools, different webinars on them, co-hosted webinars with some of their education providers in the old days before they were bought out too at Thinkorswim, and it didn't really suit what I was doing at the time. Great tools, don't get me wrong. It's just that for what I was doing, it was almost overkill. I wasn't trading spreads at the time, and the spreads I were trading were just simple diagonal spreads. Didn't look at it. Interactive Brokers does, I think, still have the best commissions out there. I realize that. But I'm kind of comfortable with the tools that I have right now and the commissions that I have for what I trade because I'm not going day by day. The closest thing I've done to multi-trading in a week and multi-positions with the account size I have is the last 4 months playing with these 1 week out straddles on earnings. Okay, buying straddles going into earnings based on requirements of, you know, having a certain volatility, having a certain put call ratio and so forth, other technical and fundamental criteria Ernie and I are tweaking for our 1 week out long straddle positions. So that's the closest I've come to even considering day trading. So I might have as many as 12 to 10 positions open in a 3-day period that are closed within a day, or at least definitely closed by Friday, and then it opened 4 or 5 more from Wednesday, Thursday. And again, Nancy says you should take a look at Tasty Trade. I haven't really looked at them yet on those as well for Tasty Trade on that also. Okay, so yeah, I know they came out after I can't remember what they call it, but yeah, after Tasty Trade came out with, you know, they've been doing the online stuff with Tom Sosnoff and everything for a while. Then they released their education wing, and then they released their the trading tool wing as well. So it's another opportunity out there, but right now, Nancy says you're probably throwing away hundreds of commissions. Believe me, the commission rates that I pay right now, even with Fidelity and Options Express, is not affecting my returns that much at all. So could I have a little bit more? Yeah, but you know, I'm looking at positions that when I have a loss, you know, it might be as much as 20 or 30% depending on the movement after earnings. And then, of course, with the gains. And I'm not talking 100 contract positions at all. That's not my account size. So I'm in a reasonable range, and the commissions for 15, 20 contracts, I maybe say $40, $50, but it's been okay with what I've been making. 15 to 20 contracts on a straddle, perfectly fine with it. Sure, but thank you, Nancy. I appreciate that. I could do more, but right now, honestly, I'm going on vacation for a week, so I don't even want to think about it. I really did. To be honest with you, I was such a fan of Trade Monsters. I really like their tools, and I like Options House too. I've met those guys 3 times now, two times. I met them 2 times in Chicago. The heads there at Options House, great little organization, very fun guys, and the guys at Trade Monster, they developed it from the ground up, and they did little subtle variations of what they wanted to see from what other new brokers were coming out with. And I thought Trade Monster was really slick. And I didn't want to be in the middle of changing over, and they are in upheaval. And like I said, I've never looked at the Tasty Trade tools. To tell you the truth, I'm focusing on what I'm doing right now, and the commissions aren't hurting me at all. So I'm not too worried about that at this point as well. Okay. All right, so let's see. Oh, and Nancy says August 23rd, there'll be no commissions for trades. I don't even think I'm going to be trading on August 23rd. I don't think I'm going to be in town, okay? James says, are you going to teach us how to trade straddles for earnings? I'm still working on it, to be telling you the truth. I've been trading it for about 4.5 months now. At one point, I was up 80% in a 3-month period of the money I had allocated to do it, and then it started to trail off from that. So I'm still trying to do that and work it a different way, okay? Yeah, and Sam says that trading has to be simple and not complex, which can be hard to manage and understand as well. Yeah, and that's true, and that's why even Sam, sometimes you mention the comments there that you talk about doing the bull put credit spread with the out of the money long call, and then it moves up, and then you do the bear call, and that might even be too complicated to me. And Nancy, I've talked to many times before. She loves Condors. She does other spreads positions as well, and she does other trading strategies. Sam, I know, and even James, who comments in occasionally. I know for a fact that all 3 of you, and even Paul, who commented in as well, I know you guys trade more than I do. And what do I mean by that? I mean that you mostly all have seen what I do during the week, where every Tuesday, Wednesday, Thursday, and Friday, I'm usually hosting some webinar or another, sending out an email for the webinar, of course, then converting the webinar over, then sending out another email when the archive has been posted after we post the webinar, and of course then in between that I've got coaching sessions, the regular emails, and the regular phone calls. So in general, I'm only looking at my Power Options account, even though Power Options is usually in front of me all day long as I'm doing coaching sessions and other things or taking screenshots for upcoming webinars. I'm actually only looking at my account for maybe a total of 25 minutes a day, sometimes maybe an hour, depending on what I need to do with some of those straddles. But that's essentially it. So, I'm not trading as actively as you guys are. I'm not trading as big positions as you guys likely are as well, okay? All right. Okay. All right, I'm sorry, Nancy, I didn't you said, I'm sorry, Nancy did make a comment. She liked their tools. They're pretty basic, and they're not basic, but they're very, very slick and easy to use, of course. And then she wanted to remind everyone about the no commissions at the Tasty Trade new trading platform on August 23rd. It shows August 23rd. There's got to be something going on that day. As well as the low commissions, but then she says she thinks you've gone past what the site has done, and I don't know if you mean the Tasty Trade trading site or Power Options, of course. And Sam, don't get me wrong. What I was saying is I like your idea of what you do, so I don't have one right now, but what I was referring to is when Sam has a position that's hit resistance. Why do I keep doing that? Let me try to use one of mine that's been dropping, and I don't know if it's hit resistance yet. But see, the stock's at Mondelez is at 43.48, and it's been falling. But let's say here I think it's at the bottom. So I'm going to open a bull put here with a 43.41 spread. And what Sam's going to do is he's going to open, maybe buy a cheap 46 call. Okay, so he'll do a bull put spread at this time, but he does stocks that have much better volatility, so he sees better premium on it. And so you've got the structure that looks like this. Okay, it's a gain here in the middle, and then it really takes off. Right? He's paid some money back in for the call of the net credit he received, so it's a small net credit. But if he's right, if it bounces off and now it goes up to, let's say, 45, he can do one of two things. So it goes up to, let's say, 45. He could sell the August 45 or 45.50 call for probably close to 57 cents. Right? It kind of legs into that bear side if he thinks now that 45 was the resistance. Or if he's still bullish and the stock continues, goes up to maybe 45.50, he could also now maybe double dip and sell a 47 call, but at that point, it's probably going to be worth 30 cents. So he's got a bull call debit with the bull put credit, but now the stock has continued to move up. So he's going to bump that line up, and it can still have further profit up to that strike. It's a useful strategy to do when you time it right, of course, as well, so you can let the one side run or manipulate it once you've moved from a support to a resistance. Okay? All right. Okay, going back to the last comment, James says, are you going to teach us how to do straddles for earnings? Yeah, the new approach that I have, we've discussed a couple times. That's not where I wanted to go. We've discussed it a couple times here in the requested topics section here. Let's see. No. Oh, the bank earnings coming up. We talk about kind of the structure we'd be doing there as well. And when Ernie and I get our report done on that position, okay, what we're going to do is you're going to see our search there from what we've finalized to maximize return on the values for the earnings there. And then we're going to go ahead and that point as well, you're going to see the long straddle search there also changed for the earnings position. We're going to have a webinar on that, still doing the Bollinger Bands and so forth, upper and lower, looking for breakouts as well and more. So you'll have that available to you pretty soon. As I mentioned, I'm going to be going personally next week, but we do have webinars coming up. When we come back, we're going to talk about that debit spreads versus credit spreads. The fascinating thing I found out related to credit spreads, of course, and debit spreads was when we did our back testing, when we're going to have our picks of the day for bull put credit spreads with the highest performance we could get over a 2-year period. What was amazing to us is that the criteria we found, we're looking for spreads that are actually 14 days out in time. Why? Because every test we've run with the same criteria, looking for certain types of stocks, avoiding earnings and things like that, every time we go 2 weeks out, we outperform the same exact criteria and only going 7 days out. Because you get those smaller net credits, the losses hurt more. And I've actually saw going 1 week out in time with the same stock criteria, looking for the same type of return and probability with 1 week out options, 5 days out if you open on a Monday, over a 2-year period was a 72% loss, whereas the 2 week out with the same stock criteria, same stock selected, but being able to get a higher premium with the same probability was actually a 56% gain. It was amazing how much that flipped. Also, using 1-point spreads always resulted in a loss. It was fascinating how much that it just suddenly, you just have that small window where it breaks through on a credit spread with a 50-cent or 1-point spread. So you always hit the maximum loss very quickly, and you're taking those 100% losses on the position. But if you do a 2 or 3-point spread, you only lose 20 to 30%, maybe 40% on average. But you're also getting a higher net credit to begin with, instead of doing a 50-cent spread for 5 cents, which is an 11.1% return, but in an instant, you're at 100% loss. So these were all fascinating, and Nancy realized that, says gamma hurts you too much on 1 week out in time, or can hurt you too much. That's exactly right. But I was fascinated by the results. Same stocks, similar criteria, trying to do credit spreads week by week by week, instead of every 2 weeks out, was a 72% loss on a portfolio over a 2-year period compared to an 86% gain or close to it. It's amazing. Just a simple thing. Anyway, that's what's going to be shown sometimes later, and in relation to the bull put picks of the day. Then we'll start talking about these straddles. And they're risky, and you got to take a lot of face value into them, but at the same time, they can be extremely profitable. No, that was old. Those aren't the ones there. All right. Well, ladies and gentlemen, I don't see any other questions that have come in. I appreciate you joining me for today's webinar. I hope you guys all have a fantastic week next week. You still will hear some more educational information from me going forward into next week, of course. And then again, I'll be back here on August 16th for that debit and credit spreads, and we'll also see you Friday the 18th, expiration day, for our another, of course, open forum Q&A session as well. Okay, so yeah, there we go. My apologies, folks. Just wanted to mention that. August 16th and August 18th as well. And of course, remember, if you haven't done so in a while, remember you can go to poweropt.com, put in your name and email address, and you'll be able to access the 14-day free trial there to test the tools for 14 days. And of course, you can see the subscription services after that, starting at $40 per month for the end-of-day data. And then, of course, they move up if you want 20-minute delayed real-time or access to our historical suite of tools for the back testing, where the historical data goes back to 2006. Now, you want to take a look at other free stuff. Remember, you can check out the blog at any time, blog.poweropt.com. Our free webinars page is poweropt.com/webinars.asp. There's coverage on just about every strategy already there for you. And of course, with these theme strategies we're getting into, you see those too. Remember, you can visit us anytime on YouTube as well. All right, so if you think of any questions later on, remember you can send us an email to support@poweropt.com. You can also send an email to support@radioactivetrading.com. Remember, you can also call us during office hours at any time at 302-992-7971. Okay, and of course, remember, trial members and subscribers, you can schedule a coaching session at any time. All right, ladies and gentlemen, thank you very much. Have a fantastic weekend, and we'll see you soon. Take care, everyone. Happy trading. Good night.